Good afternoon, everyone, and a happy St. Patrick's Day to you all. Welcome to this REFIRE and Targa Communications online roundtable regarding the residential property market. My name is Andrew Barber and I am Managing Director of Targa Communications in London, and I would like to wish you all, as I said, a very happy St. Patrick's Day. The focus of today's event is the German residential market, and over the next hour or so we will be talking about finding a home for your money. It is now 12 months since Germany entered lockdown due to the COVID-19 pandemic, and it is exactly a year ago today that, along with the European Union, Germany closed its borders to travellers from outside the bloc for 30 days and advised its citizens not to travel abroad. Sobering thoughts. A commonly used phrase from this time last year was that the coronavirus does not discriminate. While that might be true in terms of transmission within the human population, the consequences of the pandemic on property markets around the world have not been so clear-cut, and the impact has been more severe in some markets than in others. Some sectors, such as retail, hospitality and leisure, have experienced extreme challenges, and many operators are unfortunately unlikely to survive. Other sectors, however, such as logistics and telecommunications, have seen a surge in demand and can be seen to have benefited from the crisis. There is no doubt that in the context of the pandemic, the residential market can also be seen to be a big winner. Demand for housing in the metropolises has remained high, with rents and purchase prices continuing to rise. Working from home has increased the interest in living space in the suburbs of the big cities, and those who don't have to go to the office can easily compensate for any longer travel times with more space and lower costs. Properties with gardens that help to make lockdown more bearable are also becoming increasingly popular. However, it remains to be seen whether these are sustainable trends or just flashes against the backdrop of the pandemic. As well addressing these issues, today's roundtable will consider the political situation, looking at the capping of rents and the possibility of greater state intervention within the market over the longer term. To discuss these issues, Targa Communications and REFIRE have assembled a panel of experts from the residential market who will be providing you with their considered thoughts on the subject. Our first panellist today is Andreas Friedrich, who is Managing Director of Asset and Portfolio Management at Domizil Real Estate Group in Munich. Andreas is responsible for the strategic planning and management for individual properties and portfolios from their purchase through the asset management process and then the subsequent exit. Next on the panel, let me introduce Mark Holtz, Group Head Research at CORESTATE Group. Mark is kindly standing today for his colleague, Lambros Repas, who is unfortunately unable to join us. Mark joined CORESTATE last year and was previously Senior Researcher at BNP Paribas Real Estate Investment Management in Munich for 5 years. To help set the scene for today's roundtable, Mark will shortly be providing us with a brief overview of Germany's residential market. Let me now introduce to you Barber Schomburg, Managing Partner of Kingston Investment Management. Barber has a vast experience in management positions within the fund and real estate industry, and for 7 years was previously CEO of Aberdeen Property Investors Deutschland. Before that, she was Managing Director of Alliance Immobilien GmbH. Barber now uses her experience to assist domestic and foreign investors navigate the challenges of the German real estate markets. Our final panellist today is Thomas Wunsch, who is Senior Director of Investment Management and Head of Germany and Austria for Greystar. Thomas is leading the business's expansion within the German-speaking markets, and he's been with Greystar since 2016 and is a specialist in development, investment, management and capital raising. Our lead moderator today is, once again, Mr. Charles Kingston, CEO and publisher of REFIRE, the online publication for international investors, which is focused exclusively on the German real estate markets and has been reporting in the English language since 2006. So without any further delay, I will now ask Mark Holtz from CORESTATE Group to provide us with a short presentation regarding the German residential market. Mark, over to you.
Thank you very much, Andrew. Yeah, my name is Mark Holtz. I'm the Group Head of Research with CORESTATE Capital. CORESTATE is an integrated full-service investment manager, and one of our key fields in terms of investing is actually the German residential market. That's standing assets, that's forward commitments, but that's also more niche aspects of the sector, which is micro-living, for example, which is student housing. But now let's get into the slides here. What I have prepared is a brief overview of the German residential market, explaining where we are right now and why we are there. And I want to get into the presentation by stressing the very polycentric structure of Germany as a country itself. This is very, very natural to us Germans, but actually talking to international investors, this is still quite unusual. Thinking about France and the UK, for example, where Paris and London make up 25 to 30% of the country's GDP. This is very, very different in Germany because Berlin only makes up 4% of the country's GDP. And if you take the top 4 cities, it's only 14% of the GDP. So it's much more polycentric than many other countries out there. And this actually drills down even into the Tier 2 and Tier 3 markets, which is what I wanted to highlight with this map. What we have here is an overview of the locations of the major leading German company headquarters. And what you can see very easily, it's scattered all across the country. Those headquarters are pretty much everywhere. And I'll come back to that point later because that opens up quite nice investment opportunities for investors, even outside the Tier 1 markets. But now let's have a look at how the German market has performed over, let's say, over the long run. What I'm showing here is European house prices, house price index as a proxy to the residential market in general, and I have highlighted Germany as the blue line in here. And I think there's 2 key takeaways from this chart. First of all, Germany was one of the outperformers over the last 10 to 12 years with strongly rising rents and rising values. But before that, actually, looking at the period between 2000 and 2010, roughly, Germany actually did not go anywhere. And while there are some concerns in the market that Germany has become expensive, this is actually putting, if you rebase this index, is putting this message into a different perspective, to say so. Well, admittedly, this is sort of a statistical hat trick. I've rebased the index to 2000 here, but what you can see is basically that Germany is catching up to a trend that has been going on in Europe for a longer time. Now, one of the reasons why this was or is the case is the supply situation that we have in Germany, which is what I'm indicating with this slide. So the bars represent for each year the amount of new apartments that have been delivered to the market. The horizontal line is what experts expect is the needed new supply per year. And as you can see, there's 2 phases again. It's the 90s and early 2000s, where we've actually overshot in new construction. So we've built too much. And actually, this was a time when the demand side was quite weak. At the time, the German economy was struggling. Germany was coined the sick man in Europe. And so a lot of supply hit a relatively weak demand base. And this actually caused supply to go down again and developers to become more cautious. And over pretty much every year of the last 15 years, the new supply didn't meet the new supply demand. And over time, this caused a severe supply shortage in Germany, which actually led to the stronger performance that we've seen. So this is the supply side. Let's have a look at the demand side, which is what I'm showing here. This is a forward-looking perspective. And as we all know, there are some demographic aspects that we need to consider. And still, the general prospect is that the population of Germany will probably peak somewhere, sometime over the next 5 to 10 years, which is the gray area in the background. But what is probably more important for us is the household side, because that is actually creating demand for residential units for property. And that is what I've highlighted here with the individual lines. And if you look at the blue line, those are the expected trajectory of smaller one-person households. And actually, there's just a growing trend for the next 30 years. And it really is the larger apartments that are expected to see a decline. And in combination of the two, it's still some growth over the next 10 years, and then pretty much a stable outlook. Now, this profile might actually change a bit when, as Andrew mentioned already coming in, with the COVID impact, people might want larger apartments now because they want a proper office. But for the time being, this is still a pretty relevant aspect to consider. And I want to spend a couple more minutes on the quality of the demand side, which I'm highlighting on this slide. Because I think living in general has become more diverse over the last 10 years, and it will continue to be diverse. And there's a lot of different drivers creating different demand for different type of properties. If you look at the very left, for example, the huge population cohort of the baby boomers are about to retire. They're getting older, they're becoming seniors. And many of them are so-called empty nesters. So the kids have left the house, and what remains is one or two person household in a too large house. And these people might actually reconsider the way they want to live. Leave the large house behind them, leave the stairs behind them, which is this picture showing with the stairs behind this gentleman, and move into a more urban area, move into smaller apartments, move into senior-ready apartments. Another trend that we are seeing increasingly is demand for more like micro-living apartments, for serviced apartments, these kind of things. Community is an aspect to consider here. The very increasing mobility of the workforce is a very, very important aspect. Flexibility is a very important aspect. Services and amenities is an important aspect. And this is actually a field that has come into play over the last 5 to 10 years, really. And we strongly expect that it will remain very, very relevant. Now, if you combine supply and demand in the real estate space, what you typically get is rental values. And this is what I have highlighted in the left chart here. Here I have broken down the average rent for new built properties into the tier 1, tier 2, 3, and tier 4 cities. And there's, again, I think, two major takeaways from the graph. First of all, I've indexed this to the year 2007, so to make these different tiers comparable in terms of the rental profile. And I think first of all, you can again see the two different phases that the German market has gone through. Pretty much no dynamic at all between pretty much the mid-90s until 2007, and 2007, and then the market really took off in terms of rental growth. And the other key aspect to take away from this is that the dynamics between individual market tiers are actually very, very similar. Sure, the tier 1 markets, if you look closely, they had this development of rising rents earlier, but tier 2, 3, and 4 followed suit and have seen a very, very similar dynamic in terms of rental growth following that. And the same actually applies to residential yields, to net initial or gross initial yield, which I have highlighted here on the right side. Clearly, tier 1 is more expensive, yields are lower, but again, the dynamics that we have seen in terms of falling yields have been very, very similar throughout the markets. And as Andrew has mentioned going into the presentation, 2020, a generally very difficult year with GDP declining by more than 5%, it looks like that the residential market has been hardly affected by it at all. Now, bringing this all together into one slide, and I want to end on this slide. This is a quite messy slide, and there's a lot going on, but I don't want to go into details anyway. So what we are having here is on the X scale, you have the gross initial yield for individual cities, and on the Y-axis, the rental growth over the last 5 years. So the higher a market is, the stronger your rental growth. The further to the right, the cheaper the market is to get into. And there's a few key messages to make here. First of all, there is some clouding going on, of course. You have the tier 1 markets further to the left, so they're generally more expensive. You've got tier 2 somewhere in the middle, and you've got more of the tier 3 markets to the right. But what is most interesting here is that in terms of rental growth, they're all over the place. So you can find tier 3 markets which have higher rental growth than tier 1 markets, for example. So there are tier 2 and tier 3 markets which are actually very, very attractive to get into as an investor. The only thing is you need to be fully on top of things. You need to understand the market. You need to know what is the right product for the right market. If you do, then I think Germany has quite a few attractive investment targets in terms of residential investments. And with this messy slide, I want to end the presentation, and I think we're going right into the discussion now.
Yes, thank you very much for your update there, Mark. Greatly appreciated. Charles, over to you.
Great, Andrew. Thank you very much. Mark, thank you for a very concise, compact presentation of where the markets have been and where we are now. And I think today's discussion, what I'd like to do in today's discussion, we've got some very good high caliber people on the panel here who can tell us a lot, bring a lot of different experience from different sides of the residential market to the table. What I'd like to do today is to, given where we are, have a look at what each person's strength is here and try to assess where, at the end of the day, at the end of this presentation, where there may be opportunities. You've indicated that there are opportunities there, but it does probably require a certain amount of differentiation. We've had a great round in Germany, as everybody knows, and the word safe haven has been bandied around now for 5-10 years. But even before the coronavirus outbreak, there was hints that things were, storm clouds were gathering, and that not everything was going to be such a one-way path as it has been in the past. So, and we're seeing, apart from the usual Bundesbank annual statements about how the markets are 30% overvalued, they've been saying this for the last 11 years. And since then, things have just continued to carry on upwards. There are no doubt certain segments here which will be of interest, and our job this afternoon is to try to identify where those opportunities are, but also try to pinpoint where some of the threats might be, and there are threats as well. So what I'd like to do, just to kick this discussion off, if I may, I'd like to ask Mark, you've been reasonably bullish there in your presentation. I'd like to ask the other three panelists for a quick little 2-minute presentation as to what their main interest is in the real estate market and whether they are in general bullish or tending more towards caution at the moment. And Bärbel, perhaps I could start with you. You know this market very well, and you've got a good cross-section of experience in the German markets.
Yeah, thank you very much, Charles. Actually, I've seen the market for, let's say, 40 years by now. And I've seen also all these decades when residential was definitely not sexy enough for investors, and because there were no growth expectations. I still remember the time at Allianz Insurance when we sold our residential stock. And it's interesting enough to see that at least Germany has now taken up with developments in international markets. And so actually what we do is always we follow our investors. We give them advice, no question at all, but we can't act against the appetite of our investors. And at the moment, definitely investors do not like hotels. They do not like retail shopping malls, and also they are a bit reluctant to invest into offices. And luckily enough, we started as Kingston Investment Management during the fourth quarter of last year to have our first fund concentrating on residential with some convenience retail joined. And so we were happy to collect investors' money, equity within, let's say, 3 to 4 months of now 160 million euro, which is quite a good result for our still quite young investment management company. And so we are now definitely very bullish on residential, but I have to say we are probably not the tier one investor because we feel that yields are too low, and our institutional investors, they look for opportunities, and we have a lot of expertise in the southern part of Germany in growth areas and where the demographics are taken into account. That is our approach to it. We will have some more niche investments in the future in a different fund, which is on social impact investments for elderly care and elderly homes. That is something which will come in the second half of this year. So this is a niche offer where we have a team of experts in place who already have done this for many, many years. And furthermore, we will have some international residential product in place also to come in the second half of this year.
Very good. And we can get back to that again later on when we look at some of the categories that might be of interest to investors. Andreas Friedrich from Domizil, you're based in the south. You know a lot about the markets. I know that your business has expanded across all of Germany, but actually the DNA of your business has also been very much the business of residential and the privatization of residential, hasn't it?
Yes, the Domizil comes from the privatization sector. It started around 11, 12 years ago. And we started in Munich in the south of Bavaria, went to Regensburg, Frankfurt, Cologne, to Hamburg, then invested all over Germany. And since 3 years, we extended our business model to the investment management for third parties also. And what I would not recommend at the moment is to invest in the A cities. What we see, what we all know, is that the yields are too low there. Our view is better to invest in B and C locations where the risk is not much higher, but where you can generate more higher yields, higher IRRs expected. And what we have also seen in the last years is the trend. The winners are the outer urban districts, and this was also fueled by the Corona situation, that people, not only the families who moved out years ago because of lack of apartments in the cities, of residential units in the cities, they moved out to the outer districts, but also smaller households, especially in the crisis, moved to the outer cities. And it's more easy for them now it's more attractive also to live there when you have home office for 2 or 3 days. Then it makes it less painful to drive to the office.
So you're another believer that, as Mark said earlier on, we could be snuffling around in the B and C areas and perhaps the suburban areas to look for value. Well, we'll get on again. We'll get on to look at that and also the reasons why that may be the case, and are they really standing up, those reasons? Thomas Greystar, you're very experienced across the world in in housing, various segments. Tell us about your approach in Germany.
Yeah, thanks, Charles. So I think probably I'm taking a different view here on some of the things that kind of my predecessors kind of mentioned. I think Greystar itself is a very specialized operator, developer, and investor with a clear focus on rental residential. So for kind of 30 years of the company's history, we've never done anything else but rental residential. So in that sense, we don't necessarily follow our investors, but investors come to us if they think they need exposure to residential. What we like to do typically, and it applies to the US, to Europe, Asia, and also to Germany, is to combine our investment strategy with mega trends that we see in the respective markets. And I think the mega trends that we rely on for Germany continue to be urbanization, kind of the change in lifestyle. I think kind of Mark mentioned that before, a less structured life, more mobile people that are more service prone. They value service, they value the flexibility they get. But what we also see is kind of an increasing concern around affordability. So the question is kind of how does that problem can be solved in a population that tends to kind of live alone or maximum in two-person households. So combining these kind of patterns, what we see in especially the top 7 markets of Germany is a significant undersupply generally, but also a kind of mismatch with kind of the demand drivers that I mentioned just now, and kind of the residents' willingness to get a better product, a purpose-built product to live in. In that regard, kind of our focus is really much on the top 7 cities with greater liquidity that we see in these markets, with a resident group that caters well to our concept, which is really heavily relying on providing on-site services, providing amenities, so ranging from lounge spaces, concierge services to gyms. We try to develop or acquire large-scale projects because what we don't want to do is to create a luxury product. We don't want to develop 20 apartments and create a rooftop terrace with a gym on the ground floor and have everyone pay kind of 20-25% more in rent. So what we try to do is offer services but at an affordable rent check with purpose-built design apartment layouts, efficiently designed for rent, not for sale, which is quite a unique phenomenon we see in Germany. So that translates to our investment pattern that is really flexible in regards to the deal structure. So we would generally kind of develop ground up. We commit to forward deals, but we also acquire existing stock. But we're very stringent on the product. So while we kind of pursue various strategies, including kind of multifamily, student housing, senior housing, we're really specific on the asset meeting our criteria. And in that regard, we've been quite successful. So kind of in terms of the fundraising, so the investor demand is certainly there. We've kind of raised a couple of $100 million for Europe and Germany specifically in recent months. So we see there is certainly demand from the investor side to follow us into these cities based on a strategy I outlined.
Okay, so what I'm hearing there very much is that you, with your strategy, are looking for the kind of areas that will be perhaps less affected by any of the global threats, or the threats within Germany very specifically. For example, if you're talking about a small inner city unit that is ideal for single people or small family units, people who don't need gardens, these are people who are perhaps less affected by perhaps any of the political trends that are becoming more apparent in Germany today. Would you agree? Is that true?
Well, I think I wouldn't limit our scope to kind of inner city developments, kind of micro units or student housing units. I think there's a relevant business case also for kind of out of town locations, for a bit more generous apartment layouts with kind of green spaces surrounding potentially a kind of co-working center in the asset or nearby. So kind of to facilitate the kind of working from home environment, or kind of the flexibility that employers do have, or we expect them to have in coming years. So in that regard, I wouldn't limit our investment scope, but to your specific questions on regulation, I think that's a wide field. I don't think we're kind of less affected with our strategy than others. I think we have to kind of deal with the limitations that come with it. So I think we found ways to deal with it, but I guess that is a relatively wide field.
Yeah. Okay. Mark, CORESTATE has been what Andreas has just been talking about is among the other specialities they have is student housing, but CORESTATE was one of the very first companies into this segment 10, 12, 13 years ago in Germany, and has certainly ridden that wave. There's evidence now that their returns in the student sector and in the micro-living sector are not as good as they were some years ago. What can you tell us about that segment of the market?
Well, yes and no. It depends on when you have gotten into the market. When did you buy your properties? I mean, the running assets that we have are operationally performing very, very well. And even during the COVID situation, our occupancy rates in our student housing portfolio in Germany never fell below 90%, which is quite astonishing. It was even 94, I think, was the lowest that we have. So it clearly is part of the living residential spectrum, which was more defensive in this situation. But generally, I mean, you're right. Student housing has gone out of the niche corner into becoming more mainstream. There's more interest from German investors. There's more interest from international investors. And as you have more interest into the asset class, that is, of course, also driving prices. And student housing is not immune to the general trend of falling yields. So going into the sector now, clearly your yield going forward will be lower than what you would have gotten if you've gone into like 2 or 3 years ago. That said, I think your returns are still very, very decent, especially compared to the very classic residential segment. With student housing even in the A markets, you can get returns of 4-5%, somewhere in this range, which is difficult in the classical residential sector. And I think student housing is really one of those sectors with structural tailwinds, because we are living in a super disruptive time where knowledge is basically everything. And I feel that the job market will remain challenging, not just cyclically, but structurally. There's a lot of automation going on. Reproducible office workers are replaced by software and smart AI solutions. So what can you do to stand out on the job market? You have to have the highest education as possible. And I think that in the long run is simply a very, very good case, while universities will remain extremely important or even grow in importance. So that is why I believe in the long run it is a sector with decent structural tailwinds.
Well, last year, for the first time, residential was a bigger investment sector in Germany than the commercial market. So obviously, there's quite a few people still believing that this is the safe field, the safe area to be in, along probably with logistics, which is another whole story, and certain aspects of retail, such as grocery anchored retail. And we know that the other segments are struggling, particularly accelerated by COVID, perhaps not caused by COVID, but accelerated by COVID. So we've just had elections in 2 prosperous southern German states on Sunday, and Angela Merkel's party has taken a serious thumping. At the same time, in the background, there is rumblings generally about the housing crisis, the shortage of housing. You mentioned earlier in your charts. You showed some interesting demographic charts. As a general rule, we are short of housing in this country. Now, the question is, with likely possible political developments in Germany, what do you all believe is the possible effect of a shift to the left? There's already move to extend Berlin's situation. First of all, from all of you, what do you think is likely to happen? Will the Constitutional Court overrule the Mietendeckel in Berlin? And in general, what are your views as to the role that politics is likely to play in the general setting of prices for both rents and for prices of residential? Mark, a quick word from you while you're there, and then I'd like to ask Andreas.
Well, I'm certainly not an expert in this field, but I think, Mietendeckel and capping rents is a means to avoid markets from overshooting and overheating too quickly, but it doesn't deal with the problem itself, which is there's too little supply. So I think it can help in the short term of preventing rents from going up too much, but in the long run, it actually creates uncertainty. It prevents new buildings, so it might be actually counterproductive. So it can.
What is the message? What is the message that it is sending out to international investors, or do they still believe, macroeconomically things are still so strong that Germany will be able to see this one out?
Well, there's some concern, and nobody really knows. That's the issue. And clearly, it makes Berlin, for example, less appealing than it was like 2 years ago. So there's some restraint from international investors going into it.
Andreas, your company has signed a big deal a couple of years ago with one of the major Danish pension funds, who are clearly not afraid to wade right in there into the German market. What are they saying? What is your company saying about the general trend to try to get the housing situation under control?
Coming back to the Berliner Mietendeckel, I have a clear view of it. There can only be one state be responsible for the rental laws, and this is the Bund. This is the German constitution. In my view, it is not. It can't be that Berlin has its own legislation. So it's unconstitutional. That's the one thing. The other thing is that it's kind of a depropriation that we have in Berlin, that the state is going into the laws as they did. Therefore, what I see, what is the risk is that when we get a left swing in the German election this year, then also it can be there's a little risk that the Mietendeckel is be extended to all over Germany. Okay.
Bärbel, you've already raised quite a lot of money even through the lockdown for your funds, and your next fund is a residential fund.
Yes, definitely.
Give us some insight into what your investors are saying about the overall climate in Germany.
Actually, I also are very much involved in these issues for the political issues because I'm deputy president of the German Property Federation called SIA. Yes. So we deal a lot with all these issues, and we have a clear view, and it's not only us, but it's also the investors themselves. We have seen that in Berlin, due to the Mietendeckel, building permits went down dramatically, applications for building permits. So this is the answer of the economic answer. And therefore, these restrictions are definitely not the right way to have more residential space in place. And therefore, demand will increase. There is a supply shortage, and that means that in the end, even rents will be higher. And only those who are in a flat living in a flat, an existing flat, they will take advantage from that. And in the end, that is really not our social means to prevent increase of rents, because it evokes the contrary. Furthermore, I strongly believe that the Bundesverfassungsgericht will definitely decide that the Mietendeckel is not in conformity with our constitution. That is what Andreas also mentioned. And our investors, first of all, we don't invest in Berlin at this point in time. It's not only about Mietendeckel, but because we feel that tier 1 cities might be too expensive. But in other growth areas, we feel quite comfortable, and the same is with our investors because they see within residential, it's a diversification of risk. It's a long-term approach. We need growth areas to choose. And this is something where investment and asset managers can definitely differentiate if they have the right means in place to evaluate which are the right areas to invest in. And there we have all the market reviews and research, and we have evaluation in place. But we go not only a different way, but we go further down the road. We have a joint venture with a company using artificial intelligence to evaluate definitely the future growth of areas. They evaluate the infrastructure. They have all comparables available. They have all the data available, what will happen in the future in that area. And
but
that is...
Barber, with respect, there are companies who do this, and they were not able to foresee, for example, the Mietendeckel. They were not able to foresee a shift to the left in a city like Berlin. And I'm asking, therefore, do you see any danger of infection across Germany, that other cities could take up the arms of Berlin and say, here in Frankfurt, here in Munich, things are out of control, and we cannot afford housing for our workers. I'm not really too worried about the 1,000 new staff that Apple are going to try to hire in Munich, because they're probably going to be so well paid anyway.
Yeah, that's for sure. But what Thomas mentioned before, we all have to concentrate not on luxury dwellings and apartments. We have definitely try to find to establish affordable residentials. But then we have to ask ourselves, what are the cost drivers? And the cost drivers are sometimes the communities themselves. There's a cost of land. There are lengthy processes for building permits, for example. We have high construction costs because we have also a lot of restriction. If we see how the Dutch builders or developers build their houses, and we see how it works in Germany, then we know where all these cost overrun comes from. And that is something we also want to bring down bureaucracy. And it's definitely looking at things from different angles. It's not only by law having restrictions in place. People who are sensible thinking, they will find shortly that there is no reason, or it doesn't make any effect to have this Mietendeckel, because there is a shortage in supply on the short run even.
There may be a shortage of supply, but the question is the number of Baugenehmigungen, the building permits, also the figures that have just been released are also really quite shocking about last year. So here's another question to all four of you. There are proposals to create new housing and perhaps relieve the pressure somewhat by a manner of different ways of creating housing, converting offices, for example, into housing. Do your companies have to take some of this? Are you getting involved actively in looking at that? Perhaps, Mark, that's something for CORESTATE, because you guys are involved so much across the whole spectrum. But also, Thomas, I'm thinking, do you look at existing properties that are commercial properties that are possibly going to be empty offices, and say that's something that we could turn into housing? And how seriously would you look at these things?
We're not that deep in the conversation game yet. Still, we're of course thinking about it, because, as you say, there might be opportunities coming from the office side, particularly in suburban office parks, which might be half empty in the future. Who knows? Whatever. There might be interesting ideas going into. The others that we think is a good means of stimulating some construction is, for example, the KfW loans, which actually make constructing new residential cheaper and more attractive, actually, for investors as well. So that is one thing that already helps stimulate some construction activity. Other than that, we're looking at mostly, for example, Stadtquartiere, new city developments within city centers, like old brownfield sites, reconstructed into new urban centers. That is something we're looking at very closely, and we're very active in, and actively trying to encourage all sorts of housing in there, affordable housing, free market housing, to get this mixture that you actually want in an urban environment like that.
Thomas, would Greystar consider, are these things you look at? Do you look at existing other purposed assets and say that's an area, that's something we could turn into our kind of housing?
Yeah, Charles, I mean, in times of cheap money and low yields, product shortages dominate the real estate market. So we try to be as flexible as possible. I think the big question is, like, when do you enter into such product, right, or such project? Do you enter like by acquiring existing office, hotel, as an example, and then you close on the land and you try to rezone, or do you enter into the deal at the later stage? I think if it's the first, I think kind of the difficulties that come with it is obviously kind of the intransparent process with kind of the planning department. So it is not only a time aspect, which is a significant one, because kind of a timeline for rezoning properties can range from probably 18 months to an unlimited amount of years. So in that regard, the risk associated with rezoning properties is relatively high, and in Germany, obviously, you have to look at the every deal individually, but generally high. And in that regard, investors do expect a certain return to enter into that risk, which doesn't really help, to alleviate the problems we have in the housing market, because what we want to do is kind of provide supply to the market. Obviously, it's pretty simple. If you look at demand supply patterns in the German housing markets, that's when you see why prices have increased so much over the recent years. So we have to provide more supply. If the procedures with the planning department stay as bureaucratic as they are today, it won't help us really resolving that kind of supply-demand mismatch. And so I would say yes, but it depends on the deal and kind of the return expectations.
Charles, if I may add, there are more challenges which we will face, because we have to obey the ESG rules, we have to obey European taxonomy, and if we have elderly buildings, then it's mostly not possible to convert them into ESG compliant buildings. And that is something our investors nowadays, they ask for modern buildings which will have a rating in place, which are definitely in conformity with everything what EU taxonomy asks for. They want our funds to be category 8 and 9 funds and things like that. And so it's more or less in the end the newly built building, and then we have the forward funding issue. And this is difficult because everyone wants to have the same product in the end.
But is it not the case that with all this newly built property, the prices are so high that for most people, for most people looking for affordable housing, only some form of political intervention can try to get them the kind of housing that they need?
Not necessarily, because you can have also means to build like prefabricated parts for the buildings, so that you can definitely bring costs down. And then cost of land and things like that. There you have to choose the right location, the right partner, and then you can definitely try to figure out a product that is in the end suitable also for affordable rents. But then you have to see the context with other European countries. And that was something Mark showed in the beginning, that people are complaining they started maybe in Berlin with a rent of €4 per square meter. And now the average rent is, I had the SIA figures, is €6.50 or 80. So in the end, have a look at Spain, at France, at UK figures. You see that it's definitely still in average cheaper to rent a flat in Germany than in other European countries.
Charles, can I jump in? I've got a couple of questions going back slightly. One is concerning the possible expropriation of property. Is that affecting investors' attitudes? And I also had a question on yields with Tier 1 locations seeing yields close to 2%. How will that work in an environment where there will inevitably be interest rate rises?
Andreas, perhaps from Domizil, I'd like to.
The first question, the expropriation, I think it's not very probable. The risk is not very high that it's extended to all over Germany. I think it's going to be it's a temporary discussion in Berlin. At the moment, it's limited until 2025, and I don't think that it's going to be. And my view is that we will have a decision from the highest court in the second quarter, and then we will. I hope, or I think it's probable that we get the decision that the Berliner Mietendeckel is going to be abolished. That will end on short notice.
The other question was about yields, and with tier 1 cities being close to 2%, how will that work in an environment where you will inevitably see interest rate rises? Who would like to answer that? Mark?
I'm not sure if it's that inevitable that interest rates will rise. I mean, yes, inflation has gone up recently and probably will go up, continue to go up this year. But still, the ECB cannot act on rising inflation in this year. If they would, half of Europe would be in trouble, as they cannot, fulfill their payments on debt. So rising interest rates is really a long-term issue, unless there's a dramatic rise in inflation. Then you never know. But still, then the ECB would be in trouble. But just playing the case through, what if interest rates would keep rising if the ECB had to raise rates? Yes, of course, that would be difficult for these kind of low yields. But you have to consider the main reasons why these interest rates would rise would be rising inflation, and that would actually also increase your running income, because a lot of the leases that you have are indexed to the inflation. So your running income would probably go up. It's just that the exit could become more difficult at a price that you have put in going into the business case.
Thank you.
Thomas, have you anything to add on that? I mean, I don't think any of us are expecting interest rates to rise within the immediate future. So by and large, institutional investors are still taking the view that as long as there's a spread between even a low 3% in German residential and what I'm getting in government bonds, although they have been rising, I can still justify this to my investors because there is a spread, and that's what so far is keeping people still so glued into the residential and also the commercial market, but particularly residential, which in Germany is still seen as such a safe haven. Although, Bebel, I'd have to take issue with you on one thing there. I mean, you are right in saying that yes, compared to other countries, the German rents are low. There is an issue here, though, which is perhaps not at the forefront of institutional investors' minds, but there is also the other issue of Germany's very low level of home occupation, of home ownership. And that means that despite Germany's wealth, Germans are, in fact, on a per capita basis, among those with the least amount of wealth in Europe. In fact, in terms of home ownership, apart from Switzerland, Germany is rock bottom, well below Italy, well below Greece, well below Spain. So there are distortions in those markets which make things slightly different when it comes to attitudes towards home ownership. Now,
even though this will change in these countries with the home ownership nowadays because of the crisis and economical crisis, probably more younger people in urban areas like Paris or Milan or Madrid will not be able to have ownership in the future. We see the same. I mentioned it to you when we had our discussion before. We see it, for example, in Warsaw, where there was, after the communist time, a major percentage of ownership, but that was with the old buildings. And nowadays, people have a different approach, and they cannot afford anymore to have ownership. So I think this might equalize within Europe.
But so what you're saying is the rest of Europe is likely to move more towards the German model than the Germans to move to the other people's ownership model.
Yeah, before Germany moves to ownership model, it will take decades, I would say. They spend the money more likely for other things, for traveling, which is not possible at the moment. So they can save for their homes.
Okay. Andrew, do we have some other questions from the audience at the moment?
We've got a question about micro-living, which I have to confess I don't entirely understand, but it's a question of pricing between micro-living properties in a B city that might have an A micro location. So I'm guessing that sort of questions about the quality of the locations. Is there going to be much difference? I don't know.
Thomas Rich and Mark Holtz, this has got your name written all over it, I think. Yeah, Thomas, please. Thomas, will you go first on this?
Yeah, let me just kind of rephrase the question so I get it right. So I think the question was whether there's a pricing difference between kind of A and B locations within a tier 1 or tier 2 city. Is that?
I think that's what I was trying to say. Thomas,
yeah.
Thank you.
I mean, kind of, if you look at the cost drivers of a real estate development, then typically you can kind of break it down into land, hard costs, and soft cost. Hard cost and soft cost don't necessarily differ from a kind of B micro location to an A micro location, and hard costs have been kind of one of the major drivers, obviously, of kind of the rising real estate prices in recent years. So kind of long story short, we do see a pricing difference, certainly. What pricing difference do we see? I would say if you look at the tier 1 city and you compare kind of city center with kind of fringe location, I would say it's probably like around 15% on capital values and pricing difference that we see for like products. So new build, similar specifications. That's about the delta that we see.
Mark.
Well, not much to add there, really. Just one thing. Well, micro living. If you're thinking micro living or student housing, it depends. If your university is not in the city center, but it's in a fringe location, of course, having a student housing in a fringe location is certainly an A location for this student housing asset. So it very much depends on what exactly you're looking at and what kind of city and location. But yeah, certainly there is price differences between city center, edge of cities, and tier 1 versus tier 2 and tier 3 cities. Yeah.
Well, Mark, this all sounds as if you are, in fact, very bullish on the fact that foreign students will come back to Germany, who are not there at the moment, that students, in fact, will come back from their homes and come back to Göttingen or Tübingen or wherever and actually take up accommodation in the numbers that were originally projected. Is there anything you see there that might prevent that happening?
I'm not sure if you've seen the news today that the new international student numbers declined by 21% last year. Given the horrible circumstances that we were in, I think 20% decline is totally manageable. I wouldn't have been surprised, if it was have been much higher. But you're right. I sound terribly bullish today, but I think Germany is in a very good position to attract international students, because it is a very open and liberal economy. It is a very safe and secure economy. It doesn't shoot itself in the foot like the UK, where it's just leaving the EU. It doesn't have the tensions to Asia like the US has. It has a lot of value for the money, so it's relatively cheap to study here. So there's actually a lot of good reasons, and many courses are taught in English as well. There's many reasons for Germany to become even more attractive than it is right now.
Yes, I think Germany came a little late to the student game, but once they realized how people like Maastricht were attracting students from all over the world, and British and Irish students and so on, they realized we're made for all of this. And in many cases, the third and fourth years are being exclusively taught in English these days. So it's considered, absolutely international. What, may I ask you all, if you look out at your environments ahead for the next couple of years, we've touched on some of these political issues, we've touched on some of the financial issues, investors perhaps looking a little scary at the low margins and the low yields. What would you consider threats to the rosy pictures that you are talking to your investors about? What could throw that? Now that we are coming out of COVID, is it all good news, or do you have other threats on the horizon that you think could throw these plans overboard or threaten them? Germany's had a wonderful long run for 12 years, almost uninterrupted, almost exclusive in Europe to have had such a good run. How long can this go on?
I think that the general risk remains the economy. We did have a dip of GDP more than 5% last year, but honestly, we actually didn't really feel that yet. Wages didn't go down, the unemployment rate didn't shoot up. There's still a lot of risks of economic headwinds coming through this year and also next year, which could be headwinds for rental developments in the residential sector for sure. So you need to be very considerate when thinking about your rental growth profile over the next couple of years. I don't think it will be as strong as it has been, the last 5 years. It will be lower. It might be even zero, or it can dip in some markets. But I think the general overall environment, the economic situation, and in the long run, potentially also the demographic situations are still risks to consider.
In Munich, Andreas, when you sit around talking about Domicil's huge expansion plans, and I know you've doubled, tripled in growth in the last 3 years, what do you see as potential clouds on the horizon?
What I don't think that we have decreasing rents, but I don't think that they will increase as they had increased in the last years. What I don't think that there's much risk looking at the interests we get from the banks from the financing. What I don't think that we will see falling prices in the next years, but I also don't see much increasing prices in the next years. I think we will have in the next years slightly increasing prices. That's my view on the market, on the political situation we have.
So Thomas, if Andreas is right there, you guys are going to have to start to forage a lot more, root around a lot more carefully to find those little gems that are good for Greystar.
Well, that's our ambition anyway, right? No, I mean, I would echo Mark's comment on the industry itself. I think kind of German economy needs to kind of reinvent itself, and that will be a big bet going forward. I think if you look at the demographics, I think immigration law will be decisive to kind of get skilled labor into the country, which kind of fuels demand for rental housing, right? So I think these are kind of two the major aspects. I think if it comes to value creation going forward in real estate, I think kind of Mark explained it earlier with kind of their move into student housing, where they basically kind of developed a new industry for the local market, for the German market, where they basically occupy a niche sector, make it institutional, and with the growing institutionalization, yields compress and you create value, right? But you can only create value, and that's kind of my personal view going forward, not only by financial engineering, right? I think that has been kind of the story of the kind of last 15 years in private equity real estate. I think there's so much competition in that field that it's hard to differentiate. I think going forward, you got to offer a management platform. You got to offer more value add on the operational level. And that, I mean, specifically in the kind of niche industries like student housing, potentially kind of, senior living, but also kind of outside of the residential space. But that's for us the future. And as you know, kind of Greystar is set up in a way that we are not only the investor or the investment manager, but also the operator. So in that sense, we feel well equipped to add additional value, also in times of tight yields and high capital values.
Great. And Barber, with the rollout of your funds, and particularly, I know you've got it's also part of residential, which is altersgerechte Wohnung. In other words, residential living for elderly people with a degree of service attached to it. I think you would echo what Thomas is just saying, that it's the service element there that
definitely. You have to find your niche. The overall challenge is the economical development in general, but that is something everybody has to face now in the near future. And our country has to modernize a lot of things. We have to digitize our life, and we have to be less bureaucratic. That is the overall setup. But within this environment, investment and asset managers have to try to differentiate, to be, first of all, on top of the curve, to have niche products in place, to have a pipeline available, and to make the best out of these competitive situation.
Which is obviously what you're doing at the moment. Well, look, that's a very clear statement, and a clear statement from all of you. I will hand back, I think, at this stage to Andrew. Andrew may have a couple more questions there, in which case he will put them to. But I would just say, with an eye on the clock, we don't want to run too far over time. I would just say thank you all very much indeed for a very good discussion, plenty of food for thought in all of that, coming from four very distinct, different perspectives. Andrew, unless there's something else, I'll hand back to you.
Well, we had a question which was age specific, so I'm going to change it slightly. And if you were to advise a new entrant into the market, perhaps myself, very quickly, what strategy would you recommend to someone new to the market? I'll go round the table. Mark, have you got any thoughts on that?
Well, you mean as an institutional investor?
Yeah, well,
looking to invest
as an institution, yeah, sure. New entrant, new international investor. What What would your, very
go
briefly,
direct, or to go into a fund, or to go into a listed company, for example? Of those three options, right?
yeah, something like that.
All right, let's ask.
Very
Mark,
quickly.
Mark,
Well,
obviously,
I understood it more like a sector specific or market specific question.
maybe.
If I do understand it this way, I think even though there's potentially tendencies that people will move to the edge of cities, for me, still urban living will remain a long-term growth story. So anything created around urban living, and urban can mean the big metropolises, but also can mean tier 2 or 3 cities, will be the main target that I would go to.
Okay. Andreas, can I ask you that question? Where should I be putting my money?
It's the first time to get a feeling for Germany. I wouldn't invest in an opportunistic fund or something like that. This, I think, you should start with the core plus product with a light value add share. And I would invest, as I've already mentioned, in BC locations where he can expect further proper yields on the one hand, and where the risk is not too high.
Okay, thank you. Barber.
Yeah, I would recommend to choose the right investment and asset manager, first of all. And that has not necessarily to be one of these very, very big players in the market, because you need a certain platform. You need people who are very enthusiastic and on one hand, but who are as well very have a long-term experience and have a track record. And then you will discuss with your investment and asset managers what is your risk and return profile, and then you will find the right way to invest into this market.
Thank you. And Thomas.
Yeah, all what Barber said, I'd say, and I'd also suggest kind of investing in a discretionary vehicle to give your manager a bit more flexibility. We're currently in fundraising for a value add fund, and in that sense, I'd also say allow some flexibility regarding developments, since in a market with shortage of product, you want to be able to create something. So get that exposure.
Okay. Thank you. Well, I think that's we have overrun. Thank you, Charles. Could I extend my thanks to our panelists today? So that's Andreas Friedrich of Domizil Real Estate, Mark Holtz of CORESTATE Group, Bärbel Schumberg of Kingston Investment Management, and Thomas Wunscher of Greystar. And again, thank you, Charles, for moderating today's discussion. I must also thank you, the audience, for attending this event. You will also find this details of our next Investing in Germany Roundtable, which is on the 21st of April, which will be focused on the country's healthcare and senior living markets. Please stay safe. We look forward to you joining us again very soon, and a good afternoon to all of you.
Thank you very much.
Thank you.
Thank you, everybody.
Thank you.